One machine. One company almost nobody had heard of a week earlier. And somehow it dragged down four of the most important names in the entire global chip industry in a single trading session, three of which don't even make the machine at the center of the story. When news broke that a state-backed Chinese firm had started mass-producing its own advanced lithography equipment, ASML took the expected hit. That part made headlines on its own. But look closer at that trading session, and something stranger happened. Applied Materials fell, Lam Research fell, KLA fell. None of these three companies make the machine China just built. They make completely different equipment for completely different stages of chip manufacturing. So why did Wall Street punish all three of them anyway? For a breakthrough that, on paper, had nothing to do with any of them directly? That question is what we're digging into today, because the answer says something much bigger about how fragile the West's grip on chip manufacturing equipment might actually be, and about how markets process fear before they process facts. Here's the quick, accurate version of the story, since a lot of the initial coverage got some of the details wrong. On July 27, 2026, Reuters reported that Shanghai Aishengya Electronic Technology Group, a little-known state-owned company, had begun mass-producing domestically developed immersion deep ultraviolet, or DUV, lithography machines. These are the tools used to etch precise circuit patterns onto silicon wafers. Aishengya built this capability by absorbing engineering teams from several other Chinese firms, including Shanghai Yuliangsheng Technology, a startup that had reportedly been testing a DUV prototype at SMIC, China's largest chip foundry, since late 2025. Some early coverage attributed the mass production announcement directly to Yuliangsheng Technology by name. Reuters' original reporting is more careful than that. It describes an unnamed state-backed Shanghai company that brought together development teams from multiple firms, including Yuliangsheng, with sources asking not to be identified. Treating this as a clean Yuliangsheng launch overstates what the sourcing actually supports. Aishengya appears to be the entity actually running production. For decades, this specific category of machine, immersion DUV lithography, had been dominated almost entirely by one company, ASML, based in the Netherlands. The reported production plan is modest, roughly 5 machines delivered in 2026, scaling to about 20 in 2027, with initial customers expected to include SMIC, Huahong Semiconductor, and Chongqing Memory Technologies, or CXMT, 3 of China's most important domestic chip makers. The market reaction was immediate and, in percentage terms, severe. ASML shares fell hard on the news. Reported figures range from roughly 6% to more than 8%, depending on the exact measurement window and which trading session you're looking at, with the stock briefly touching its lowest level since early June. By most estimates, that single session wiped out somewhere in the neighborhood of $44 billion in ASML's equity value, more than 4 times the company's entire implied 2026 China revenue, which gives you a sense of just how far the reaction outran the immediate dollars actually at stake. The original transcript described the loss simply as tens of billions of euros, without a specific figure. A more precise estimate, cited across several financial outlets, puts the single-day equity value destruction at roughly $44 billion. That part of the story made intuitive sense to most people almost instantly. China built a competing machine, so the company that used to hold something close to a monopoly on that machine took a hit. Simple cause and effect. But here's where it gets more interesting, and where today's story actually picks up. The sell-off didn't stay contained to ASML. Applied Materials, Lam Research, and KLA, 3 American companies making entirely different categories of semiconductor manufacturing equipment, all declined too, with reported single-day drops ranging roughly between 3% and 7%, depending on the source and the exact time of measurement. None of these 3 companies build lithography machines. None of them were directly threatened by this specific breakthrough. And yet, investors sold their shares anyway, on the same day, for what turned out to be the same underlying reason. To understand why this happened, you need to understand how chip manufacturing actually works as a multi-step industrial process, and why investors reacted the way they did. Making an advanced computer chip isn't a single step. It's a long, precise sequence. Wafer cleaning, material deposition, lithography and patterning, etching, ion implantation, inspection, and dozens of other stages, each requiring its own highly specialized, extraordinarily expensive equipment. For decades, that entire equipment stack has been dominated by a small handful of companies concentrated heavily in the United States, the Netherlands, and Japan. ASML controls advanced lithography and holds an outright monopoly on extreme ultraviolet, or EUV, machines specifically. The category needed for the most cutting-edge chips, and the ones still fully blocked from export to China under current controls. Applied Materials specializes in deposition and a wide range of other manufacturing steps, Lam Research dominates etching, the process of precisely removing material to carve out circuit patterns. KLA specializes in inspection and defect detection, the quality control layer that catches manufacturing errors before they turn into costly failed chips. KLA holds an estimated 60% share of the broader process control equipment market, with no single competitor above roughly 8%. Lithography has always been considered the single hardest, most technically demanding step in that entire chain, the one category of equipment that seemed genuinely out of reach for any competitor to replicate anytime soon. That's exactly why China's breakthrough here generated such an outsized reaction. If lithography, widely regarded as the crown jewel of semiconductor manufacturing equipment, the step everyone assumed China was furthest behind on, had actually been cracked, even at a less advanced DUV tier rather than EUV, investors immediately started asking an uncomfortable follow-up question. What does that imply about China's progress on the supposedly easier steps? The deposition, etching, and inspection equipment that Applied Materials, Lam Research, and KLA specialize in. It's worth being precise about what DUV versus EUV actually means here, since the distinction is doing a lot of work in this story. Deep ultraviolet lithography uses a 193 nanometer light source, technology that's been commercially mature for roughly 2 decades and can be used in an immersion configuration, passing the light through a thin layer of purified water between the lens and the wafer to squeeze out finer resolution than dry DUV alone allows. Extreme ultraviolet lithography, by contrast, uses a dramatically shorter 5 nanometer wavelength generated by vaporizing microscopic droplets of molten tin with a laser tens of thousands of times per second, and remains a technology only ASML has ever successfully commercialized at scale. China's reported breakthrough sits firmly in the DUV category, genuinely difficult to replicate, but a full generation removed from the EUV tier that produces the world's most advanced processors. That's the logic that dragged all 3 companies down alongside ASML. It wasn't a reaction to a specific competing product. Any of them had actually lost business to that day. It was a reaction to a shifted assumption about the entire trajectory of China's equipment industry, and shifted assumptions about long-term trajectory are exactly the kind of thing that moves stock prices fast, well before any of the underlying business fundamentals have actually changed. It's worth getting specific here, because these 4 companies aren't equally exposed to what's happening in China, and understanding the differences helps explain why investors reacted with somewhat varying intensity across the group. Lam Research carries the highest China revenue concentration of the group by a meaningful margin. China represented roughly 35% of Lam's revenue in its most recently reported quarter, and had peaked even higher, around 43%, just 1 quarter earlier, at times representing the company's single largest national market. That heavy concentration is exactly why some analysts flag Lam Research specifically as carrying the greatest structural risk if China's domestic equipment industry continues advancing across multiple categories simultaneously, not just lithography. Applied Materials sits at a somewhat lower but still substantial exposure level, with China representing approximately 30% of its total revenue in fiscal 2025, a figure that had already declined about 16% year over year to roughly $8, $53 billion, as existing export restrictions bit into sales, with the company projecting a further $600 million revenue hit in fiscal 2026 from those same restrictions. ASML itself reported China accounting for somewhere in the range of 29% to 33% of its full year 2025 revenue, depending on which measure you use, though that figure has already been falling sharply through 2026, down to roughly 19% of net systems revenue in the first quarter of 2026, and further still to around 14% in the second quarter, largely because tightening export restrictions increasingly limit what equipment ASML can even legally sell into China, regardless of underlying demand. ASML's own management has publicly guided toward a further significant decline in China revenue for the remainder of 2026. The original transcript stated ASML's China exposure was close to 30% of total sales in the most recent full year, without further detail. That figure is roughly accurate for full year 2025, but the more current and relevant number by mid-2026 had already fallen much further to somewhere between 14% and 19%, depending on the specific quarter, reflecting the accelerating effect of export restrictions rather than a stable baseline. KLA's exposure is the most genuinely nuanced of the 4. In dollar and percentage terms, KLA's China exposure has actually been substantial too, reported at 33% of fiscal 2025 revenue and as high as 39%. 5% in one recent quarter, so it isn't simply smaller than the others in raw exposure. The original transcript characterized KLA as somewhat better insulated than the others, without clarifying why. The more accurate picture is that KLA's China revenue share is comparable to or higher than Applied Materials in some periods, The insulation argument some analysts make is specifically about KLA's product mix being less directly targeted by the categories of export restrictions currently in force, not about KLA having smaller China revenue overall. Barclays, for instance, upgraded KLA specifically citing relative insulation from certain export control headwinds, a narrower claim than blanket lower exposure. That's an important nuance because it shows this isn't simply a story where every Western equipment company faces identical risk in identical ways. Each company's specific product mix, customer relationships, and existing China dependency shapes how vulnerable it genuinely is, even though the market's initial reaction on the day of the news treated all four companies with roughly similar alarm. Now here's a genuinely important counterpoint, because not everyone watching this story agreed that dragging Applied Materials, Lam Research, and KLA down alongside ASML actually made logical sense. Multiple analysts pushed back on the underlying assumption driving the broader sell-off, and within hours of the initial panic, several major firms stepped in publicly to defend the sector, arguing the market was conflating a limited prototype stage milestone with an imminent, fully proven commercial threat. The reasoning goes something like this. Lithography is considered the hardest step in chip manufacturing precisely because it requires an extraordinarily unique combination of ultra-precision optics, laser physics, and mechanical engineering. A combination that took ASML literally decades of accumulated highly specialized expertise to perfect. The fact that China managed to crack that specific, uniquely difficult category doesn't automatically mean deposition, etching, or inspection equipment. Categories relying on genuinely different underlying technologies and manufacturing expertise entirely suddenly become easy for Chinese companies to replicate as well. Analyst Didier Samama, covering the sector, went as far as calling the day's weakness in ASML shares an attractive buying opportunity, and reiterated a buy rating with a price target well above where the stock traded that day, arguing the panic had overshot the fundamentals. By the final hour of that trading session, several of the stocks had already pared back a meaningful portion of their steepest intraday losses, as this more skeptical analyst view spread through the market. It's also worth being honest about something the original telling of this story missed. This specific trading day wasn't a single cause event. The same session opened with a Wall Street Journal report that NVIDIA was in talks to guarantee roughly $250 billion in financing for an OpenAI data center project. A separate story about AI infrastructure spending that was already generating its own market anxiety before the DUV news even broke. Untangling exactly how much of the semiconductor equipment sell-off traces to the China lithography news specifically versus broader AI spending jitters landing in the same news cycle is genuinely difficult, and most contemporaneous coverage treated the two as compounding rather than cleanly separable. If that pushback is genuinely reasonable, and there's a strong case that it is, why did the sell-off spread across all four companies regardless? This gets at something important about how markets process genuinely uncertain, high-stakes strategic news, separate from whether the underlying technical reasoning holds up perfectly under close scrutiny. Markets often price in worst-case trajectory shifts faster than they price in nuanced, category-by-category technical analysis, especially in a sector where the underlying technology is genuinely difficult for most investors, and frankly most journalists, to fully evaluate in real time. When a milestone this symbolically significant breaks, China cracking the single hardest category everyone assumed was safely out of reach, the market's initial instinct tends to reprice the entire sector's long-term risk profile first, and sort out the more careful, category-specific nuance considerably later, once analysts have had time to dig through exactly how transferable this specific breakthrough genuinely is to other equipment categories. There's also a policy dimension worth naming, one the original telling of this story left out entirely. This news landed just as the U.S. Congress was advancing the Bipartisan Match Act, legislation specifically aimed at tightening restrictions on China's ability to buy or receive servicing for exactly this category of DUV machines. If China can now build comparable machines domestically, the pending legislation risks losing much of its intended bite, a reality that adds a genuine strategic dimension to the story beyond simple market psychology. There's a psychological dimension too. ASML's lithography position had functioned for years as something close to a symbol of unassailable Western technological dominance within the semiconductor industry specifically. The moment that symbol showed a genuine crack, even a narrow, contained one, limited to a less advanced tier of the technology, it inevitably raised broader questions in investors' minds about how secure every other piece of the Western equipment position genuinely is, regardless of whether those specific fears turn out to be technically justified once the dust settles. It's worth adding some real localization context here too, because it complicates both the panic and the pushback. According to industry tracking, cited in recent coverage, China's domestic equipment localization already varies enormously by category. and had been progressing along its own separate timeline for years before this specific lithography news broke. Some equipment categories, like photoresist stripping and single wafer cleaning tools, already sit at meaningfully higher domestic production shares than the more complex categories. More specialized categories, advanced metrology, inspection equipment, and lithography itself, remain considerably further behind, with lithography specifically still overwhelmingly dependent on ASML for anything at the true cutting edge, even accounting for this new breakthrough. Unverified, remove or check. The specific percentage figures by equipment category cited in some early coverage of this story could not be independently confirmed against a named dated industry source, and should be treated as directional rather than precise. It's worth placing this sell-off within a broader pattern that's already played out multiple times across the ongoing US-China technology competition, because this contagion effect isn't a one-off anomaly. It's become something close to a recurring market reflex. In late April 2026, when reports emerged that equipment makers had been informed of fresh export restrictions, specifically affecting deliveries to facilities operated by Hua-Hong Semiconductor, shares across the same group moved together again. Lam Research fell about 1%, KLA declined roughly 4%, 7%, and Applied Materials dropped nearly 5%, 8%, even though that specific restriction targeted a narrower set of customers and equipment categories than July's lithography breakthrough involved. That earlier reaction, months before the DUV story broke, shows investors had already developed something close to a standing reflex around this entire sector. Any significant China-related semiconductor equipment news, whether a new export restriction or a new domestic breakthrough, tends to move all four of these companies together as a single, tightly correlated group, regardless of which specific company the news technically concerns. That correlated trading behavior makes a certain amount of sense from a risk management perspective, even if it occasionally overstates the actual underlying business impact on any single company. Institutional investors managing large semiconductor equipment sector positions often treat these four companies as a single thematic basket, reasoning that China-related regulatory and competitive risk is fundamentally a shared, sector-wide exposure rather than something cleanly isolated to whichever company a specific news story most directly implicates. So where does this leave things, and what should you actually watch for over the coming months to judge whether this contagion fear was justified or overblown? Watch the equipment categories where Chinese localization was already progressing before this DUV breakthrough, particularly etching and deposition, since those are closest to lithography and complexity and most directly relevant to Lam Research and Applied Materials specifically. If localization rates in those categories accelerate meaningfully faster than their historical trend line over the next year or two, that would support the market's broader contagion fear being genuinely justified rather than simply an emotional overreaction. If those categories continue advancing along roughly the same gradual pace they were already on, that would support the more skeptical analyst view that this was largely an overreaction limited to one narrow, uniquely difficult category. Also worth watching closely, how SMIC, Hua-Hong, and CXMT actually perform once real production volumes from these new domestic DUV machines ramp up. If the chips coming off these domestically produced machines show meaningfully lower yield rates or reliability problems compared to ASML-made equipment, exactly the kind of practical manufacturing challenge that separates a genuine breakthrough from a fully mature, commercially reliable technology, that would meaningfully cool some of the more dramatic long-term fears currently priced into Applied Materials, Lam Research, and KLA's stock reactions. And watch what happens with the Match Act specifically. Whether it advances, stalls, or gets rewritten in response to this news will itself be a meaningful signal about how seriously Washington now takes the risk that domestic Chinese production could blunt future export restrictions before they even take effect. Congressional staffers and industry lobbyists alike will likely treat this specific episode as a case study in whether export controls on mature but still difficult technology categories can realistically hold over a multi-year horizon. Here's my honest read, after digging through both the dramatic headline reaction and the more careful technical pushback that followed. I think the market's initial instinct to punish all four companies together was understandable, given how symbolically significant this specific lithography breakthrough was. But I lean toward the more skeptical analysts on this one. Etching, deposition, and inspection equipment genuinely do rely on different underlying physics and different accumulated manufacturing expertise than lithography does, and the existing localization data across those specific categories doesn't show any obvious acceleration directly tied to this particular news. That said, I don't think the concern is entirely unjustified either. Even if this specific breakthrough doesn't directly transfer to other equipment categories, it represents genuine evidence that Chinese engineering teams are capable of solving harder problems on a faster timeline than many Western analysts previously assumed, and that shifted baseline expectation alone is a legitimate reason for some additional caution across the sector, even without a specific new breakthrough in etching or deposition yet. What's most interesting about this story is how clearly it illustrates the gap between how markets actually process genuinely uncertain, high-stakes technology news in real time, and how that same news eventually gets evaluated with more careful, sector-specific nuance once analysts have had time to dig in properly. The instant reaction and the more considered verdict weeks later don't always match, and this specific sell-off hitting 3 companies that weren't directly involved in the underlying breakthrough at all is a genuinely clear real-world example of exactly that gap playing out. There's a broader habit worth building from watching stories like this one unfold, and it applies well beyond semiconductor equipment stocks specifically. Whenever a single dramatic piece of news triggers a correlated reaction across an entire group of related companies, it's worth asking a simple follow-up question before assuming the market got it exactly right. Does the underlying technical or business logic actually support treating all of these companies as equally affected, or is the market simply defaulting to a convenient sector-wide narrative? Sometimes that broad correlated reaction turns out to be correctly pricing in a genuine shared risk before the specific evidence fully catches up. Other times, as the more skeptical analysts argued here, it turns out to be an oversimplification that gets gradually corrected as more careful company-specific analysis emerges over the following weeks and months. Distinguishing between those two scenarios in real time is genuinely difficult, which is exactly why stories like this one are worth revisiting periodically rather than treating the first day's dramatic headline as the final settled word on what actually happened. So here's what I want to know from you. Do you think this kind of broad, sector-wide market reaction to a single company's breakthrough is a rational way for investors to price genuine long-term strategic risk? Or is it mostly emotional overreaction that more careful analysis usually ends up correcting? There's a legitimate argument on both sides here, and I'd genuinely like to know where you land. Drop your take in the comments below. I read every single one. If you want to keep following exactly how this chip equipment story continues unfolding, along with every other major shift happening across China's semiconductor and manufacturing industries, that's exactly what this channel covers every single week. Hit subscribe so you don't miss the next update. Because between ASML, Applied Materials, Lam Research, KLA, and China's own equipment makers all racing toward the same underlying goal, this story is genuinely far from finished. See you in the next video.